Welcome back to Bitcoin Treasuries. I'm here with Jeff. Jeff, how are you doing today?
I am doing very well. Thanks for having me, Tim. Got my orange tie ready to go. Bitcoin Treasuries podcast. Excited to be
Absolutely.
here.
Absolutely.
Round two.
Do you want to start with reviewing the insurance and reinsurance market?
Yeah, yeah, absolutely. I think this is a valuable topic to discuss. I think it's very pertinent and timely, just given where things are at with the most recent LA wildfires, which I think are going to be a massive industry event in the financial markets. And I think they're going to have a pretty big ripple effect on the industry and both the reinsurance and primary insurance industry. So, um, I've got a unique perspective, particularly in the reinsurance world, reinsurance being insurance for insurance companies. So the reinsurance market is roughly there's about $800 billion of capacity in the reinsurance market, providing coverage for insurance companies to manage against catastrophic disasters on their portfolios. So if you think about how an insurance company works, an insurance company is bringing premium dollars in the door to pay out future liabilities. So a claim that they need to pay at some point in the future, whether that be a property damage loss or a slip and fall, or somebody on a job site gets hurt and can't work anymore, like workers' compensation. So what insurance companies do when they bring those premiums in the door, they are investing those dollars to pay out future claims. And in the event of a catastrophe where a lot of people are filing claims at the same time, that could put a real strain on the assets that they hold on their balance sheet. So what an insurance company will do is they'll purchase reinsurance to mitigate and manage the volatility of large catastrophic events, both from an occurrence basis, so a single event happening, or an aggregate basis, multiple large events happening over a period of time. So that's effectively why the reinsurance market exists, is to manage and mitigate that volatility on a balance sheet. So when we think about the most recent LA fires and what's going on here, this is going to be a large event in the market for the reinsurance market. I think the reinsurance market is going to be on the hook for a large number of these claims. But I think there are some really interesting nuances in the California market that, we could spend 5 hours talking about the individual components of the real estate market, the political environment, the tax structure, the insurance architecture, and all of these other things. But yeah, I think it's a useful framework to understand that there is a reinsurance market that exists to protect the downside volatility of these insurance companies.
And would it be correct to say that there's specifically a California wildfire market?
Oh yeah, yeah. There's so there are many different types of insurance companies, right? You've got some insurance companies are very small. They may write in a single state. And then you have other insurance companies that are kind of regional insurance companies, and they may stick to a certain region. Let's just say West Coast. You may have an insurance company that's really good at writing West Coast business. Alternatively, you have national insurance carriers, think like Allstate or Nationwide, where they write business across the entire US. And each one of those different insurance companies has different structures on how they manage their business in perpetuity. And depending on the design of those insurance companies, they have different pools of capital that they access for the reinsurance market. In the reinsurance market, there are many of the large nationwide insurance carriers purchase reinsurance treaties. So the reinsurance purchase is a function of their entire portfolio. So they may have Florida coverage and Texas coverage and California coverage all bundled into one specific transaction. Alternatively, some of them have them broken out. So you may have a California wildfire only specific tower to manage California wildfires. They may have a specific tower specifically for Florida. And then they may have something that like kind of sits over the top that protects, if they have an event that blows out in excess of their individual towers, whether it be a California Tower, Florida Tower, whatever. So there are infinite ways you can design these reinsurance programs, and they can be designed in different ways to manage different constraints or risk management in anybody's portfolio. But to your question, there is a California specific market for reinsurance. That market for insurance and reinsurance. To give a sense of scale, the insurance industry in California, there used to be 10 years ago, there were over 100 insurance carriers that were writing homeowners business in the state of California. Fast forward to today, there are less than 50 carriers that are writing insurance, primary insurance in the state of California. And in the reinsurance market, the reinsurance market is very constrained from wildfire because the peril itself is incredibly difficult to manage. It is so incredibly volatile, and it can happen in locations that are just hard to predict. Whereas if you think about a hurricane, when a hurricane makes landfall, the worst damage that occurs is coastal. Mm-hmm. So you know that the coastal exposures have the most risk. Now, for wildfire, you don't have like specific location. Like it's not just coastal, right? You can have risk that's inland, and you can have aggregations of risk that's inland, and it can happen in forested areas and non-forested areas. It can happen in dry grassland, or all of these different locations, and it's very dynamic. Additionally, the other challenge with the peril is that it's very poppy, right? If you have fire that touches your home's pretty much gone. Mm-hmm. Your damage ratio is 0. Your home is standing, or it's gone. It's binary. Mm-hmm. Whereas if you have a hurricane that hits your house, you may lose some roof shingles. Some of your siding may be screwed up, and maybe you have a couple broken windows. And that is a very challenging quantification for a reinsurer who's trying to understand the risk of an entire portfolio, right? Mm-hmm. And they have uncertainty in how to quantify, like how do I quantify what this company might lose in the event of a wildfire? You have to start like making assumptions on size and shape and scale and all of these different things. And because of that, a lot of the capital in the reinsurance market has left California. They just are not willing to offer any coverage for reinsurance because it's just too volatile. And additionally, another thing that's happened in the reinsurance market that's fascinating. So there's the insurance market, there's the reinsurance market, and then there's another layer called retro reinsurance, which is reinsurance for the reinsurers. Mm-hmm. Follow me here. We're gonna keep going. And most of the retro reinsurers, so this is like the last line of defense in global risk diversification. Most of the retro reinsurers have completely excluded wildfire from their coverage, saying that we're just not willing to cover it whatsoever. So what happens then is 100% of the onus of the underwriting goes to the reinsurance market. Mm-hmm. So there's no black swan. Oh, I've got, I could pass the buck. If there's a large industry event, the reinsurer is on the hook. And that changes how you make your decisions, right? If I know that I can't offload this volatility anymore on my balance sheet, that may make me a little bit more risk averse in how I manage my portfolio. Does that make sense?
Yeah. Hey guys, this episode is brought to you by OnRamp. Bitcoin custody is evolving. Both self-custody and single third-party custody come with significant risks and trade-offs. OnRamp is pioneering a new standard, multi-institution custody, which eliminates single points of failure, adding fault tolerance and redundancy to your setup. OnRamp secures your Bitcoin in a segregated, cold storage, multi-sig vault, guarded by 3 independent institutional-grade custodians, none of which have unilateral control. Multi-institution custody removes the technical, mental, and physical burdens of private key management, providing unparalleled peace of mind for you and your loved ones. To learn more, schedule a consultation with the OnRamp team. Go to www.onrampbitcoin.com. It's interesting, and I guess you would always assume that somebody would have a backstop, even if it's when you're talking about the financial engine, the Federal Reserve, and they can, in essence, print money. So can you walk us through what happens with these reinsurers if they have these extreme losses? I mean, do some of them go out of business, and obviously rates skyrocket, but is that a regional or a state or a national or thing?
Yeah. Yeah. So most of the reinsurance market is incredibly well capitalized, right? They've got, tons of capital. There is a regulatory framework for reinsurance entities that rates them. So you can have an understanding of, the ratings on balance sheets for any one of these reinsurers. And they're incredibly well capitalized, providing reinsurance coverage across the globe. And generally, any one individual reinsurance transaction may have anywhere from 10 to 50 different counterparties on it, depending on the size. And each one of those reinsurance companies is just taking a sliver up the side.
Okay.
So it's diversified. Like every individual reinsurance panel will be diversified, and you've got many carriers that are participating on every single reinsurance tower. So it's a little bit different than when you go buy car insurance or something. You've got like one provider. It's like Allstate or Nationwide or whoever it may be. And that is like further diversified with many different reinsurance entities across the globe. There are over 100 different reinsurance entities that are participating in the market, and they may take little slivers. So in terms of thinking about like catastrophic exposure here, I don't think this event, I don't think is going to cause any reinsurance entities to go out of business. Just period. I don't think that's going to happen. Insurance companies, on the other hand, I think there is some risk in California that a insurance company or two may go out of business, and we probably won't see that happen until 12 months from now. I would think about a year out, where the dust has got to settle on this loss. We need to understand how big is the loss, what's the scale, whose homes are gone, what's the cost of rebuilding, what's the reinsurance cost. Once everybody, you have to start to tally up all of this information to understand the size and scale of this claim. And what makes this loss particularly unique, and getting to your question of the Fed and money printing and infinite money supply, is a unique question. And what has happened in California, and the interesting component with this loss here, there's been, since 2018, the very large event that happened in California, the Paradise Wildfire. Since 2018, a lot of insurance carriers in the state have stopped writing homeowners business in the state. They just said, like, we can't pay for the reinsurance anymore. It's just too expensive, too prohibitive, and I can't charge the rate that I need. I can't get enough dollars in the door to pay for the risk here. And it's just fundamentally changed the risk structure. So what that's resulted in is many high risk areas being unable to buy insurance from just the private marketplace. So there just hasn't been anybody in the private marketplace that's willing to offer insurance for many of these housing locations. So what that's resulted in is a balloon and expansion in what's called the California Fair Plan. And the California Fair Plan is the residual market for insurance in California. So this is like the insurer of last resort is what it's called.
Okay.
And effectively what the California Fair Plan does is it's kind of this like pseudo public private entity, and they provide you like a very basic insurance coverage. And it's likely very underpriced, and it's meant to provide like some sort of backstop for those that need the coverage. The challenge is the maximum coverage that the Fair Plan would provide is $3 million of total insured value. Okay. So that's the max coverage limit that the California Fair Plan would provide. If you have a home that's worth more than $3 million, you would need, and you wanted the whole thing to be insured, you would need to go find somebody else to take on that risk, or you have to take on that risk net. Like, meaning if you have a complete loss, there's nobody that's going to provide you the insurance and above that $3 million. So now you can start to see where this might be an issue, right? So there's a couple things going on here. One, in LA, where this fire has happened, Pacific Palisades in particular, there the value of the homes is really high. These are high value homes in a very high value neighborhood. And I suspect that a lot of these homes, even if they did have coverage with the California Fair Plan, they have a significant exposure net in excess of the California Fair Plan. Additionally, some of the homeowners that may own their homes in those locations, they may just not have insurance coverage at all because they realized that they couldn't get any insurance coverage from the private market. Maybe the cost of the California Fair Plan policy was just too high. They didn't want to buy it. They didn't want to pay $200,000 a year to protect their, $3 million home. And they may have elected to just keep that net. And so there may be a systemic problem where you've got significant homeowners that don't have any coverage just completely. Additionally, and if you think about the architecture of the California Fair Plan, which I think is very unique, the California Fair Plan, if you think about the design, that's the worst of the worst risks in California, right? It's the insurer of last resort. The number of policies in the California Fair Plan has gone up from 80,000 policies in 2018 to over 400,000 policies in 2024. So it's gone up drastically, over 4x, right? In just a very small time period. And many of those policies are likely very underpriced. Like, they're not actuarially sound based on the actual risk exposure. And the California Fair Plan, they take in those premiums in the door and they buy as much reinsurance as they possibly can with those dollars that are coming in the door, because they want to protect their portfolio. Now, the problem is California Fair Plan only buys reinsurance up to the 1 in 40 year return period. So that's not very much reinsurance. To put it into perspective, most regulated and rated insurance carriers buy reinsurance up to the 1 in 250 year return period. Okay, so significantly higher. And if there is a loss in excess of the California Fair Plan's reinsurance tower, all of that loss in excess of the California Fair Plan is assessed on all of the admitted homeowners carriers in the state of California. So that means you could have an insurance company, and let's just make an example. You can have an insurance company that they only write business in downtown Sacramento. And if their California Fair Plan blows out of the top of their reinsurance tower from this LA event, you can have this insurance company that only has exposure to, downtown Sacramento, that is on the hook for a portion of the loss from the LA wildfires. And that could cause some very large potential issues. I think this is a very very political situation, and it can result in these pools of capital getting forced to pay out losses here in downside situations. It's complicated. This whole thing is incredibly complicated.
I guess I'm just trying to think through from literally the ground up, no pun intended. If an individual owns a home, it's not insured, it's no longer there, they could certainly sell the land for a certain amount. Do you think it's likely that there's a scenario where the federal government comes in, especially with a new administration, and or any administration, and says, we're going to make you whole, the difference between what you can sell what you could sell the land for and what the house by some measure was appraised at? Or do you see something else happening as far as
Yeah.
how all this plays out?
Yeah. I mean, that's certainly a possibility. I think there's two components in my mind. Actually, there's three components of this loss in my mind. Um, there's the insured property damage loss that's going to filter its way through the insurance market, insurance, reinsurance, etc. Then you've got the uninsured loss, which is kind of like issue number one. Which if you've got uninsured loss, who's responsible for taking on that risk? Like, are all of the people that had those homes that are uninsured, are they just shit out of luck? Does the federal government come in? Is this like an earthquake scenario, right? Like, I think, does FEMA come in and step in and help these people out? What does that look like? Who knows what that looks like? It might be the state. And then you have economic damage beyond human property loss. So you've got, roads, utility infrastructure, government buildings, government infrastructure, cost of firefighting, like all of these other components.
Mm-hmm.
And all of those components can be, that might be just as large, if not larger, than the actual property damage loss, both insured and uninsured. And that's going to be a huge bill. And I'd be curious to know exactly how that bill is going to be paid for. Another consideration that I think about, particularly from the insurance vantage point, and the concept of Fed money printing, inflation, the environment of how all this plays out. I think it's going to take a really, really, really long time to figure this stuff out for this LA wildfire in particular. 5 to 10 years, probably, in reality, because
Wow.
and if you think about these homes, right, they're high value homes.
Mm-hmm.
And high value homes require high quality materials, high quality appliances, windows, wood, steel. You need a certain, architects and engineers that are willing to design and recreate these things. And you need contractors that have the skills and capability to rebuild these things. And there's a very limited number of people that can do all of those things, right? Like, these aren't row homes, in the suburbs that are just like a blueprint. You stand it up, boom, it's done. Some of them are very complicated builds, or they just have very high quality materials, or, whatever it may be. So I think that's going to take a really long time. There's probably going to be demand surge on those high quality materials, appliances, wood, windows. And that's going to have its impact on the whole market, right? Like, the entire US. If you wanted a high quality, oven from Italy or something, you better get it now because the demand on those products is going to be really high here in the near term. So we've got a couple of components there. And if you think about, just the global macroeconomic environment, we've got the Fed has come in and they've dropped interest rates, right, over the last 6, 8, 12 months.
Mm-hmm.
And if you look at the yield curve has gone opposite. Like, the long end tail of the yield curve has gone the opposite direction. So you're seeing 10-year yield curve is going up. And that's a little bit concerning because it's the market kind of indicating that, I don't believe you, Fed, that the inflation is coming down. And I think the inflation is actually going to go back up at some point in the future. And where this becomes a really sticky, challenging situation for the insurance companies, this loss in particular, is if it takes a really long time for these claims to pay out and rebuild, the cost of those materials, if we get into another inflationary environment, 5, 6, 7, 8, 10% inflation, um, plus potentially monetary printing. This loss may go from a $20 billion loss to a $40 billion loss, right? Like we could see this thing potentially double. And, what we thought was going to be a $20 billion loss today ends up being a $40 billion loss 5 years from now, just because there's a tail to it, and inflation that kind of comes into play over the next 4 or 8 years or whatever that horizon may be. So this is I think many insurance companies are probably downplaying this a little bit, but that's my biggest concern on this potential loss is uh, demand surge, cost of good inflation on high value materials, and the time element of rebuilding 10,000 homes in a high value location. Which could get really tricky. I mean, who knows exactly how that plays out?
What else do you think is important to hit on either the insurance, the reinsurance aspects of this before we maybe talk a little bit about real estate and Bitcoin and inflation and whatever else we get to?
I think we tie it all together, right? Which is why I'm here to talk about this, because it's become very apparent that real estate is not very durable, right? Real estate is not very durable. You know what's durable? The laws of math.
Mm-hmm.
And Bitcoin relies on the laws of math as a store of value. And I think once folks start to understand that, particularly the insurance industry, right? Like if you think about the design of an insurance company and how an insurance company works, the whole the whole design of an insurance company relies on math, the law of large numbers,
Mm-hmm.
right? Like actuarial science is like is the math, the law of large numbers of understanding probability, all of these components that come into play and simulating outcomes, right? Because you bring in premiums today to pay out claims in the future. And how do you understand what claims in the future are? You understand what the claims in the future are by running analysis on, okay, I have all of this historical data and I can predict with some sort of certainty based on my historical data that the range of outcomes that I'm going to have at, time period 5 is between X and Y. And I'm going to establish a investment portfolio to manage and hit my liability numbers within the confidence interval at point T equals 5, something like that. So this is again where I think there's a lot of correlation between insurance and Bitcoin, and I think insurance companies need to start considering Bitcoin exposure on their balance sheet to manage downside volatility of their asset portfolio in the event of a inflationary monetary debasement future. It's the way I view it is it's almost like a vacuum on the other side of your balance sheet that captures any potential monetary debasement in managing your portfolio into perpetuity.
Hey guys, today's episode is brought to you by Stampseed. If you're in cold storage, you know how important it is to protect your seed phrase. That's why I recommend you head over to stampseed.com and check it out for yourself. This seed phrase storage device is one solid piece of titanium. There are no loose pieces, and you can hammer your seed phrase in letter by letter. When you go to stampseed.com, use promo code TIM15 for a 15% discount across the website. That's TIM15. Can you touch on what would need to change in order for insurance companies to either get credit for Bitcoin on their balance sheet, which I don't believe they do right now, or do they just need to bring in a proxy that has Bitcoin, like wrapped Bitcoin per se, in an equity or some sort of convertible bond or other instrument? Like how do you see that playing out over the next, call it, year?
Yeah, great question. So right now, currently, insurance companies they can hold Bitcoin on their balance sheet. However, they won't get any regulatory credit for it. or rating agency credit for it. So if you think about how, again, going back to how an insurance company works, an insurance company is supposed to hold a certain amount of capital to pay their risk into the future. There are regulators and rating agencies that run stochastic analysis on a portfolio to give them a capital rating. And that capital rating will tell them effectively, like, how strong is your balance sheet? And are you going to be around to pay out your claims into the future? Those rating agencies are meant to protect consumers. So you understand that, like, if you have a loss, your insurance company is going to exist. It's going to be there to pay out your claim into the future. So these rating agencies and the regulatory bodies, they currently do not recognize Bitcoin on your balance sheet. So if you were to put Bitcoin on your balance sheet, you get zero regulatory credit for it. So that effectively means that you can't leverage against it. Like, you can't leverage your capital portfolio against your assets on your balance sheet. Now, the other types of assets that you can hold on your balance sheet in order to protect your downside risk, you can hold equity, you can hold bonds, you can hold treasuries, you can hold all these other things. So in a world where you have an insurance company that wants some sort of Bitcoin exposure, you can get an alternative Bitcoin product, like, for example, Microstrategy convertible debt, or some sort of Bitcoin-backed bond, a Bitcoin-backed bond ETF, or even Microstrategy equity, or miner equity, or some other wrapped type of product. And those products that within the traditional market, they fit the bill for they fit within the traditional regulatory capital infrastructure. So equities, as you can imagine, carry a higher risk charge on your balance sheet because they're really volatile relative to debt, right? If you had debt on your balance sheet, depending on the rating of the debt has a much lower capital charge because it's a lot less volatile. Treasuries have a very small capital charge because it's the US government, and the US government can print money, and cash has effectively zero capital charge. So you could see there's like a risk curve of the assets that you hold on your balance sheet, and that helps. So thinking about the future, I think it's going to take a long time, personally, for the regulatory bodies, the NAIC, National Association of Insurance Commissioners, and AM Best or Demotech or KBRA, like the insurance regulators. I think it's going to take quite a while for them to kind of wrap their heads around Bitcoin and being able to put Bitcoin on the balance sheet. So I suspect in the near term, there's going to be a lot more demand for these kind of wrapped products or Bitcoin light products or other types of products to put on your balance sheet to, manage debasement risk.
One of the headlines I saw, it was the Wall Street Journal. It was an article titled, "Their wealth is in their homes. Their homes are now ash." And it just got me thinking through, certainly you can't live inside Bitcoin. You can't live inside a Bitcoin, but you also can't really deny that there are some challenges with having a significant portion of your wealth tied up in your home, in real estate, especially if it's not insured or you're self-insured. What's the solution? Like, could we see some sort of product, like a Bitcoin-backed real estate product, or like, what's the solution here?
Yeah. Okay. So I want to start with the problem. And I just want to focus on California. I mean, there's so many nuances here, but the California real estate market. So let's just take a step back and just look at the real estate market. And a lot of this comes down to like economic architecture. So if you think about the California real estate market, I think this was back in the 80s, and maybe even older, but there was this Prop 13 was passed in the state of California. And Prop 13 is related to property taxes in the state of California. And what this means is when you buy a property in California, your tax assessed value on that property can only go up 2% a year, no matter how much the value of the home goes up. So it effectively fixes the property tax of your property based on the value of the home the year that you buy it. Okay.
Mm-hmm.
And this has been in place for a really long time. I think since the 80s, maybe even older than that. And as you can imagine, this starts to create some real issues because this proposition effectively locked in a profit for any real estate investor in the state of California. Because if you have a monetary supply, M2 money supply, if your monetary supply is increasing faster than your property tax assessment, you're effectively making the delta between the two just by holding the asset.
Mm-hmm.
So, over the last 30 years, the M2 money supply has increased 6.5%. And if your property tax is only increasing 2%, you're effectively making 4.5 delta on that home value over time into perpetuity. And this incentivized people to buy homes and hold on to those homes for a really long time, recognizing the value that they're storing in that property. So for for people that own one home, it's a very challenging circumstance and a very challenging situation in California. So let's say you bought a home in 1995, and the home for $200,000, that home is now worth $2 million. If you wanted to move, you'd have to be prepared to buy a home at $2 million and pay property taxes on a $2 million home, not a $500,000 home or $200,000 home, whatever that may be. So it's effectively incentivized people to never move and hold on to these homes for a really long time. And where this gets a lot more complicated is, let's say you have a portfolio of homes, and you were incentivized. You bought rental properties in the state of California. Let's say you bought a dozen of them,
Mm-hmm.
and you've held these properties for 10, 20 years. They've been incredibly valuable propositions, but that equation is changing very quickly as the cost of insurance is rising very, very quickly. You may have vacancy rates because people are leaving California for other states that are maybe less risky. Maybe you're not even able to get insurance on some of those properties. And now that equation of like profitability is flipping and changing, right? It's that opportunity cost of capital is becoming very high. Like, there are alternative investments that might be a better store of value than holding a dozen rental properties in California, in high value locations. So then these investors are going to start changing their frame of mind for, how do I find an alternative asset where I don't have to deal with these headaches of insurance cost, vacancy, potential total loss, all of these other things, or maintenance costs, whatever that may be. And that's where Bitcoin really shines, is that, you've got a home to live in that provides utility for you. And the economic equation for having a portfolio of real estate has changed just totally drastically. And you might sell, 4 of those properties and put that value into Bitcoin. Maybe you still have, six rentals, but that's instantly putting more supply of homes back on the market for people to actually use them for what their primary purpose is like shelter, a roof over your head. And it's kind of delivering back to the utility value of these homes. Whereas so many people and families and over the last 30 years have stored all of their wealth in their homes. I mean, just growing up in California, uh, everybody's always said, like, just buy a home and hold on to it forever. And I know a dozen friends and family in California where that's their situation. They've got 100% of their family's wealth in their home. And yeah, it's a crazy equation.
Do you think between people potentially divesting of some of their real estate where they have multiple holdings, along with insurance rates going up, that brings down the price of homes in California, or not really?
Yeah, it's so tough to say. I mean, it's going to be like hyper localized. It's going to be weird in different locations. And um I personally think people are going to move north just out of wildfire exposure. I mean, this stuff is just so stressful. I've worked in the wildfire reinsurance market for 12 years and I've been following along on this stuff, and I haven't lost a home. I've visited these locations that have been burned and torched, and fire is just really incredibly scary, and I suspect people are going to be moving away from that so they never have to deal with it ever again. So, like, I don't think people are going to be moving to Arizona or Texas. I think they're going to be moving to like northern locations to not have to deal with wildfire risk into the future. But I do think, to your question, I think things are going to get revalued like quite a bit over the next decade. It's going to take so much time for all this stuff to play out, right? Like
Mm-hmm.
these, and it's going to get really complicated. People are going to try to rebuild. Some people will rebuild. Some people will move forever. Some people will try to sell the land, and then there's a question of like, can I even get insurance in these locations? Does the insurance market itself collapse in California, which is possible?
Mm-hmm.
Is there any political infrastructure or political changes to the insurance market or the design of the market that improves an insurance company's ability to to do business in California? That might get better, it might get worse. Um, and oh man, it's so tricky. I think value of homes is likely going to either stagnate or go down. It's tough to say. Like if there's more, money printing into perpetuity, right? Like if this triggers more liquidity coming into the U.S. market, maybe things just stabilize. Uh, it's so tough to say, but prime real estate will always be prime real estate. People always want to live on the best places on the planet. But if living in the best place on the planet is not economically viable in managing your personal risk, uh, then I think we're going to see a reevaluation of the value of some of those homes. And it's happened in the Florida marketplace too, right? We've seen significant hurricane activity over the last decade. Cost of reinsurance has gone up significantly. The cost of insurance in Florida has gone up significantly. If you're coastal in certain locations, it becomes very unaffordable to live in those locations because of um, the cost of insurance for those properties. So it's a little bit harder in California, in my opinion, just because the peril itself is just so volatile compared to a hurricane. Again, you can quantify and assess a hurricane and run modeled simulations over a portfolio and really assess what a hurricane damage might be, but you can't do that to the same certainty with wildfire. In the catastrophic models that we use in the reinsurance market, the standard deviation of the wildfire models is like 5 or 6 times the standard deviation of the um, hurricane models. So just to put into perspective of like how much more volatile these events are. So yeah, it's a whole tricky equation for California.
Do you think it's possible that?
Oh,
Yep.
one other thing I wanted to add there
Sure.
is people think this is worst case scenario.
Hmm.
This is not worst case scenario um, at all. And I think things could potentially get a lot worse than this fire that we've seen right now. And I think they can get significantly worse in terms of like size, scale, fire. How bad could it be? Like worst case scenario here is you have an earthquake.
Hmm.
If you have an earthquake, um, let's say let just forget this forget this wildfire that's just happened. Let's say you have a wind scenario, like a really windy period, like these Santa Ana winds and Diablo winds, and you have a poorly timed earthquake that's a big one. Let's just say like 7.5 in LA or San Francisco or something. All of a sudden, you're going to have significant potential losses in wildfires that can spread very quickly with zero ability to fight them, or like a really fractured ability to fight them because of earthquake damage that can exist in the same location. And this is that possibility. There are a couple of reinsurers that I've spoken with that um, it's funny that their pricing is like double the rest of the reinsurance market because they think that that scenario is much more likely to happen than people really realize, and they
Hmm.
underestimate that risk. And um, I mean that could be a really bad uh, I don't know, like black swan for the California market that could make things significantly worse than what they are right now. So like while people think that this this is really bad, things could be significantly worse. I mean, Lake Tahoe could be a big risk. Mammoth, Big Bear, like you've got these resort towns. You've got Oakland Hills fire. You've got Monterey, Malibu, San Luis Obispo. These are like towns with high values that could get completely wiped out. Or if you throw in an earthquake, things could be significantly worse. So that's just we've had these huge wildfire events now in 17, 18, 19, and now 24, 25. Um, that's people are going to rethink those probabilities personally. Like everybody's got to rethink that probability for themselves and in when they operate in the market, when they buy a home, when they're buying insurance, when they think about where they live, when they think about their future. That's what people are going to be thinking about, or should be. Maybe they aren't, but they should.
And all of this costs money. Like it's going to take money to address all of this, which not single handedly, but along with everything else, just adds to inflation. So, is there a scenario where inflation's going up and you just have individuals, companies, states, and governments, like federal governments, just like all FOMOing into Bitcoin because they just, not necessarily in one moment, but over the course of several years? Or what are the other potentialities?
Yeah, yeah, yeah. I think about this gradually then suddenly concept a lot because uh, people have to realize that there's a problem before they find or try to find a solution. And I don't think states FOMOing into Bitcoin is going to happen soon. I don't think that's like a next 6 months, next 12 months kind of thing. But um, I think the noise is going to get a bit louder. I think the Bitcoin noise is going to get a bit louder, particularly if there's a strategic Bitcoin reserve and the federal government starts talking about it. And you've got more people that are working in the Bitcoin space, developing wrapped products and alternative exposures to Bitcoin with less volatility. I think that's going to become more and more popular, especially as people start working on these products and developing other alternative products out for the market. For example, the Bitcoin backed bond ETF that Strive just came out with, or I think Bitwise came out with one as well. And though as those products become more popular in the market, along with IBIT, I think those Bitcoin-backed bond ETFs, I think we'll see a similar potential adoption on those products as we've seen with IBIT, because there are asset managers that are looking for that exposure with a term on it, with less volatility. So
Mhm.
um, I think it's gonna take some time, but I think events like this make people really rethink the entire equation, right? If you People in LA are literally going to be starting from scratch, right? They're going to be starting from ashes, and that is going to make them rethink their entire, not existence, but like damn near their entire, the way that they've outlined and designed their life from a business perspective. They've got to rethink that whole framework, and like business and quality of life, and um, how people live. So uh, I think it's just going to take. I think it's going to take some time. But if there are a couple more events that happen like this, in short order, that results in more inflationary pressure, I think that could cause some serious issues. If you think about like historical inflation, right? And I think you spoke with Alan, and hopefully you touched on this a little bit, but like inflation has been relatively benign, aside from 21, 22, 23. Inflation had been relatively benign for the prior 50 years. The last like horrible inflationary period was like the 70s. So if you think about who was actually impacted by inflation in the 70s, still alive today, they had to have at least been like 20 to 30 years old in the 70s. So if you're 20 to 30 years old in the 70s, that means you're 20, 50, so you're like 70, 80 right now. And those folks are the last group of people that really remember and probably felt what it was like for significant inflation, and felt the stress of like losing your purchasing power. A lot of the United States and even the world, I think, has felt the effects of inflation from 2021, 22, 23. And it's now subsiding, and people are kind of getting used to this new normal of like what things cost. But if that resurges, that could cause some significant panic of, whoa, is this the new normal? And if this is the new normal, what, how do I protect myself? Where do I park my money? What is this? I've never experienced this before. And people are going to start doing a lot more research and, you know, figuring out what these things are. So that in my mind is, I think what I'm really going to keep my eye on is any resurgence in inflation and people looking for an escape hatch, basically. And events like these California wildfires are, I think, naturally inflationary.
Really appreciate your time today. Where can people find you online?
Yeah, absolutely. Thanks for the time, Tim. This has been a blast. So people can find me online. I've got a Twitter profile. My name is Jeff Walton. My Twitter handle is @PunterJeff. I also talk about the stock Microstrategy. I've got a group called MSTR True North. We have conversations every Wednesday at 7 p.m. Pacific, 10 Eastern. Please join us, follow along. We talk about a lot of different topics, Bitcoin treasuries. We talk about Bitcoin as an asset on balance sheet. And yeah, we're getting into the nuances of capital markets and how this can all tie itself together. So very topical as usual, Tim.
Absolutely. Well, thank you, and we'll talk to you soon.
Excellent. Thanks, Tim. Talk soon. See ya.